Hey guys, Jeff Wilde here from the Day Traders Academy, and I want to share something with you that blew my mind in trading. And it's not easy to do that because I've been trading for 20 years, so as they say, this is not my first rodeo. But let me share with you something that most people, and once again myself included, did not know about money management. Now think about it. Conventional wisdom will say a good trading strategy, money wise, is you risk one. In other words, say you're going to risk 1 pip to make two, or let's say you're going to risk 100 pips to make 200. It means you risk 1 unit to make two. And basically, what that will do is you only have to be right 50% of the time, and you will still, I believe, make a 50% return on your money, being right only 50% of the time. Okay, that all is really good wisdom, providing that the market moves. It has a lot of volatility and it trends a lot, but think about it. 80% of the time the market does not trend. And all you got to do is look at any chart intraday. It goes up, it might run up 30, spike back 20, move up 40, come back 20. It's like chaotic most of the time. So just the fact that the market doesn't trend a lot means that this kind of mathematical model is not the best way to go. Now, this is what I want to share with you that people don't talk about. And this comes from the world of option trading, and everything there is like quantitatively, computer driven, where they know, for instance, let's say 10 days out, 60 days out, 120 days out, whatever day, they can tell you within a couple percent what the odds are of the market hitting that particular price. Okay, remember options are all revolve around stocks and indexes and so forth. Okay, so here's the deal. Your odds of making 2 units, in other words, let's say on this is a stock at $50. You buy here, you think the market's going to go up. Your odds of getting all the way up to $60, okay, in this particular example, each unit is $5. So 2 $5 units is going to give me 60. I will risk 1 unit, which is $5 in this case. So if all goes well, okay, and I get out at my 2 unit goal, great. But the odds are 38% that you're going to do that. But now here's where it gets interesting. Your odds of losing 1 unit or getting stopped out are 74%. Now think about this for a moment. It means that your odds are twice as high that you will get stopped out. So this is for a lot of you wondering, why the heck am I always getting stopped out? It's because your odds are a lot higher getting stopped out than hitting your 2 unit level. Okay, now of course another reason you can be getting stopped out, your stops are simply in too logical of a place. If you place them where everybody else does, and let's say your stops are too close, if you're a person that is trying to get down to like 7, 8, 10, 15 pips, your stop's too close. Okay, you have to have stops way bigger than you think you should. Okay, usually I like my stops to be a couple hundred pips, but don't let that freak you out because it still boils down to the overall risk of the portfolio. I'm not going to show you that today, but what I'm trying to do is just open your eyes to things that people aren't telling you, and which is actually not great advice in light of the fact that most of the time the market isn't trending. Okay, I will do another video that's going to give you some examples of how you can work around this, but I will leave this kind of short and sweet at just under 5 minutes because my job as like a trading coach, teacher or mentor or whatever you want to call me, is to show you better ways to do things, to open your eyes to things that perhaps you don't know, and then finally to give you solutions and workarounds so that you end up with what you want is a nice fat, healthy trading account. So that's it. Let me know what you think about this.